You know, late last week on that conference call, you were saying that you don't see any upside just so far in terms of those U.S. China trade tensions. But hopping quickly into the Bloomberg terminal here, taking a look at the GTV terminal library, it's interesting to see that U.S. LNG exports to China have been falling ever since the start of this year. What specific developments are you looking for that will inform your energy on when this could be an opportunity for you?
Look, it's a really interesting question. I think we'll need to see it play out. As you know, China's currently indicated they're considering putting tariffs on U.S. LNG imports. That hasn't been put in place yet. What it will do, though, is it will drive buyers to go look somewhere else because, of course, it's a period of uncertainty. So it means Chinese buyers are going to go out to other markets. And for recent times, of course, they've been very focused on the U.S., but now this has changed where their field of view will be. So it's too early to tell. I think there's some generally early positive things for a company like Woodside, given our proximity to Asian markets. Longer term, of course, it may have some implications on oil prices if this so-called trade war continues. But certainly in the short term, maybe some positives for us.
All right. If I were an investor, I'd love to know how well positioned Woodside is, how well positioned Australia is relative to competitors like Qatar and Russia. Help me understand this.
Well, it's a good question. Often Australia gets talked about as being a very high-cost area to produce. I think there's a little confusion there. On a production side, in fact, we're not. We're one of the lowest and most competitive regions in the world, particularly the assets that Woodside has off Western Australia. On the capital side, of course, we all went through that price explosion or cost explosion over the last few years. Of course, that's laid off now, which is why we're working very hard now to move these two massive projects forward that you talked about in your opening.
Yeah, that's right. Also, one other thing in terms of locking in rig rates here to try to make sure that costs don't get overrun. Hopping in the Bloomberg terminal one more time for our viewers. This, again, is in the GTV terminal library. And you can see that the blue line here is the drill ship rates that have been falling. Are we at an inflection point, do you think, for oil and gas prices?
Well, certainly for the oil rig rates, it will depend on the water depth, and a lot of the rigs we use are what we call very deep water depth rigs, and that market's probably going to stay suppressed for another 18 months or so. But we are seeing early signs as we go out and start to contract in the longer term, out over 5 years or so, that the owners of those rigs are reluctant to kind of lock in today's pricing. So I think, people are starting to say, hey, maybe there's some sunshine coming over the horizon, which just means for companies like us, let's take advantage of the moment. We're well financed. Our shareholders supported us at the beginning of this year with an equity raising. So let's go out and use the money that we have. Let's use it wisely, and let's make sure we can lock in this current cost structure.
Peter, it's Yvonne in Hong Kong. What does this all mean for LNG prices? Of course, we usually see this type of lag on where LNG prices go from where the crude prices are about 3 months or so. Now that we've hit these 4-year highs for LNG, do you think that we could see further price momentum heading higher?
Well, I think we are already. Yes, you're correct. The way the contracting works is typically, there's a 3-month lag in pricing before we see it come through in revenue. What does that mean is, of course, investors can have some comfort as to what our forward revenue forecasts are going to look like because they know what the last 3 months were. But if you have a look at the Japan-Korea market where it closed last week, it's significantly above where it was at the same time last year for October deliveries. And that might be an insight for us as to how strong demand is going to be through the northern winter. So, keep our fingers crossed, but it certainly looks like it's not going to be any worse than last year from a pricing point of view. Whether there's any further upside, I really can't predict.
Yeah, for the LNG industry in general, Peter, for decades we've seen a lot of companies dominated with these long-term contracts. Lately, though, we've seen actually a series of shorter contracts of just a few years. What do you think is the rationale behind this trend, and do you think that could actually continue?
Yes, I do think it'll continue. I think the average traded contracts or volumes you'll see will probably be about 50% under long-term contracts and about 50% under what we call short and medium-term contracts. And that's changing. You know, that's down from, it used to be 80 to 90% was long-term contracts. It's just changing simply because there's more liquidity in the marketplace. Buyers are more confident now that they're able to get their supplies because there are more suppliers available, there's more shipping available. And I think that's good. That's a good thing. It says LNG is becoming truly commoditized and truly traded. And it means people can get some confidence, one, that they'll have supply when they need it, and conversely, for developers like Woodside, that we can get into the market when we need to.
Do you see it as also a signal that some of these buyers of LNG are protecting themselves against a further rise in prices?
Well, I think they're looking at their own portfolios and deciding, particularly for power generators, they have different options with respect to how they generate their power, whether it's gas-fired or nuclear or otherwise. And they're looking at their tariff structure and deciding just how much they want to lock into the portfolio. It's kind of we look at it, it's akin to your debt, on your debt side of the ledger. How much do you want in long-term bonds? How much do you want in bilateral loans? How much do you want in syndicated? It's no different when you're looking on the revenue side of the business as to what you're going to pay.
Yeah, Peter, one thing also, getting back to those developments offshore in Western Australia, do you think that this is going to drive more interest, more competition even further, pushing competition prices higher as well?
You're talking about domestic gas prices in Australia?
Yes, that's right.
Not so much on the West Coast. Of course, West Coast prices are very low at the moment. They're, a fraction of what they are on the East Coast, around about a third. That's driven by the domestic gas policy that Western Australia has. So I see that market being well supplied for many years. And of course, as each project comes online, it's just actually a plus because 15% of the project's reserves that come online are actually designated to that domestic market. So it's a little counterintuitive. You'd think you're developing for export, but the reality is every time we develop an export project, more gas goes into the domestic market.
Peter, a second half looking still pretty positive for you. As you invest in more of these growth projects, how do you feel about your dividend payout ratio at the moment? Do you think that they can actually be sustained at these levels? Well, we feel pretty good about it. We, of course, look at our capacity to pay. So, we pay on a ratio of underlying profit, but of course it's really about revenue and cash in, cash out for us. We've got a lot of options going forward. We've modelled our cash requirements at maintaining equity in our projects as they currently are. We do have options over the next 18 months to 2 years to sell down some of that equity and bring other partners in. I think each time we make one of those decisions, then obviously we're able to push further out the point in time that we may need to look at that dividend payout ratio. So very comfortable with where we are at the moment. And of course, at these prices, it's continuing to support what we've been doing.